Hello, this is Rob Sechrist, President of Pelorus Equity Group. Thank you for joining us. Today, we are going to be speaking about the Pelorus Fund, which is a private mortgage REIT, asset-based lender that is providing secured, short-term loans collateralized by real estate with cannabis use tenants. Before we get into the presentation, I have to start with a legal disclaimer that past performance does not guarantee future results, and this information is subject to change at any time and is always superseded by our investment offering documents and legal disclaimers. Over the course of this presentation, I'm going to show you how our fund provides value-add bridge lending solutions to our borrowers, and I'm going to show you how we generate near equity-like returns with a cash flowing secured debt model for our investors. I want to give a US market primer on cannabis. Specifically, it is important to note that cannabis sales in the US have been expanding at a rate of 14% year over year. And with all this growth, there's massive demand. Each of these cannabis use operators needs a facility to generate the revenues. And all of these facilities need to be built. And most importantly, they require a special real estate asset class with substantial tenant improvements to generate these revenues. And that's where we come in. The Pelorus Fund provides these property owners with a high-performance, value-add improvement loan that allows the owners of these properties to build out the facilities for the tenants as quickly as possible, thus allowing the tenants to start generating revenue immediately once they have been completed. Our fund is structured where everyone wins. The property owners get stickier, high-income cannabis use tenants, which in turn generates premium yield to our investors. Now, I'm going to tell you how we are generating our higher yields. And to be clear, the higher yield performance is not indicative of a higher risk and is more related to the dislocation of the US capital markets caused by the federal policies. And additionally, how we structured the fund with a low asset management fee combined with the income alignment of sharing fees that are paid by our borrowers between the fund manager or GP and the fund members, the LPs. I'm proud to say we superseded our target yield of 15% IRR in 2019 with an annualized net IRR yield of 15.5% and achieved a 20.4% in Q4 of 2019. We are now expanding the fund offering size from 100 million to 250 million because of the high demand for our fund's loan products. The Pelorus Fund is a real estate investment trust, otherwise known as a REIT. As a fund member, the interest income qualifies for a 20% federal tax deduction and a domiciled advantage for fund members in low or no cost favorable states. An additional benefit is the REIT structure also cleanses UBTI for self-directed investors. I want to take a moment and address the COVID-19 pandemic and how this is affecting the cannabis industry. Currently, cannabis is considered a medical product in 33 states, which makes it more resilient to market interruptions, like what's happening with the COVID-19. But most importantly, cannabis was deemed an essential business. Thus, the owners of our properties, cannabis use tenants, have more potential income during economic contractions, real estate cycles, and even a worldwide pandemic. I've shared a bit about the cannabis market, the problem, and how we've structured the fund to solve this problem. Now, I want to share a bit about Pelorus Equity Group. The principals of Pelorus have raised more than $1 billion of capital that has been placed in over 5,000 transactions. I also think it's important to tell the story of how we got here. We formed Pelorus in 2010, and back then we used to get our investors 11 to 12% yields at about 65% loan to values. Then, over time, the yields compressed to 6 to 8%. But more importantly, the loan to values started to increase to 70, 75, 80, and even 90% on some purchase transactions. We've seen this show before and stopped originating non-cannabis transactions several years ago. Ultimately, that was a very crucial decision, especially given where we are today. We started originating cannabis transactions 4 years ago in 2016, and since that time, we have originated 33 transactions for a total of $65 million. Then we launched the Pelorus Fund in 2018 and converted to a mortgage REIT in 2020. Today, we are one of the most well-known cannabis lenders in the nation. Now, I want to talk about the structure of the fund. The fund is structured with income alignment. That's between the manager and the fund members, and a low management fee of 1%, but with no carried interest split to the manager, like most other funds. This means 100% of all net income goes to the fund members. Additionally, we share 25% of all origination fees, which are typically 4 points. So 25% would be 1 point. This goes to offsetting the 1 point asset management fee. And we share 75% of extension and exit fees. And when these fees are earned, the net yield to the fund members can actually go higher than the average note rate. This is how we achieved distributions as high as 18.9 and 20.4% IRRs in Q1 and Q4, respectively, in 2019. But possibly the most lucrative split is the 50% of any profit. The profit income would most likely come into place if any of the warrants that were negotiated as part of the transactions are exercised in a liquidity event, such as the cannabis company selling or going public. In this slide, we are showing two examples of a 100,000 investment over a 10-year horizon. Again, this is an example is only for educational purposes. The first model is the reinvestment strategy, where the distribution is reinvested each month, compounding 12 times annually. And in this example, at 15% target yield, the investment would increase by $344,000, in addition to the original $100,000 principal investment, for a combined total of $444,000. The cash distribution model is also an option where investors receive monthly disbursements, and over the same 10-year horizon, the strategy generates $150,000 in cash distributions, in addition to the original $100,000 principal investment. On this next slide, I go more into the specifics of 3 of our cannabis transactions. Here, I'll review these 3 transactions. The Cananbis transaction had a yield of 11.5%, an 18-month term, and the loan amount was $4.5 million. This was an acquisition and tenant improvement loan at 39% loan to value, with an improvement budget of $4.5 million, with no warrants. The Grow Packer transaction was a 15% note rate, 18-month term, $4 million loan amount. This was an acquisition, ground-up construction with tenant improvements at 45% loan to value, $2 million budget, and we were able to scrape warrants. The Rubicon transaction was a 16% rate yield, 12%, 12-month term, $5 million loan amount, and this was just a straight as-is acquisition at 46% loan to value, no budget, and no warrants. In this slide, I'm going to discuss the difference between a cannabis use property and non-cannabis use property. This specific transaction is actually off of the numbers from the Cananbis property, which was the acquisition of a 27,000 square foot completed building that we did, and it had 4.5 million of tenant improvements. So 4.5 million purchase price and 4.5 million of tenant improvements, so 9 million in costs. If we were to compare this same building as a non-cannabis transaction, the same 27,000 square foot building, it would probably trade around $2 million. The tenant improvements, if any were required, might be a couple $100,000. And the revenue for the tenant of that building might be $100,000 or so a month. And the monthly lease rate to the owner of the building might be $20,000 or so. As opposed to the cannabis use building or property, which, by the way, to be a cannabis use property, it must be within a green zone, an area designated by the city where cannabis use properties can be, and the property must have a conditional use permit, or often referred to as a CUP, that is approved for that building and allows for the cannabis use tenants to be in that building. That cannabis use conditional use permit does transfer with the sale of the property. So it is an added value, and it also transfers with the property in the event of a foreclosure. So once that's in place, now the highest and best use will always be a cannabis use operator. So in this particular example, the purchase price for the Cananbis property, same property, now as opposed to being 2 million, was actually 4.5 million. The tenant improvements were significantly higher at 4.5 million. And it's important to see the ratio. This is very common to have the tenant improvements to be almost equal to the purchase price. The tenant improvements to get these properties up and operating are massive. And that is a significant difference between cannabis properties and non-cannabis properties. Yes, they generate orders of magnitude higher income, sometimes more than 10 times income out of the same property. But also, the tenant improvements were massive to do that. And remember, the tenants typically don't have that type of money to put into a building that they don't even own. So our capital solution was designed for that. So in this particular example, to continue on with the example here, the revenue for Cananbis is 1.3 million a month, or effectively, they make just as much in 1 month as the non-cannabis would do in an entire year. Monthly lease rate on that property is about $65,000. I want to reemphasize our investments are secured by real estate, along with personal and corporate guarantees, and go into the Rohrabacher-Blumenauer Amendment. We already discussed the green zone and CUP. The Rohrabacher-Blumenauer Amendment, which is now called the Rohrabacher-Barr Amendment, if you're looking it up, has defunded the Department of Justice from any prosecution of a cannabis-related business in a medically licensed state. So what that means is that if a administration is pro or against cannabis, it doesn't matter, because the executive branch cannot instruct the judicial or the Department of Justice to prosecute these cannabis operators out there in these states. So Congress has used the power of the purse to defund any prosecutions in these medically licensed states. So once that was in place, which took place back in 2014, that is what was the pivot for us to start analyzing the sector and really seeing how we could apply our value-add lending skills to it. Ever since 2014, the Rohrabacher-Blumenauer Amendment has been renewed with overwhelming bipartisan support, and it is believed that this year it will be rolled into the omnibus spending bill. Once it's in there, every time the budget is passed or there's a continuing resolution, the amendment will continue on. So it'll be forever that Rohrabacher-Blumenauer Amendment is defunded the Department of Justice. I also want to clarify, we are lending using the value of the real estate, and we are not using the valuation of the tenants. This is really important because people conflate the two all the time and conflate the equity markets of the valuations of the cannabis operators and the stock market and all that stuff. That has nothing to do with how we value our building. We do check the credit worthiness of all of the tenants, along with personal and corporate guarantees from the sponsor of the owner of the property. So just to clarify, we are not using the valuation of the tenants when we value the buildings. We'd like to show you the inside of one of our facilities. This particular property is called Candescent. I'm reluctant to push play on this webinar because I don't want it to get choppy, but you can see this video on our YouTube channel, and you can also request a copy of it from us directly, or if you have the pitch deck, you can simply click on the link here. This property is fully stabilized. This is the Candescent property. And just to give you a little bit of background, we processed 80 draws in a 12-month period for this particular borrower. And why that's so important is because we estimate that we saved them probably 3 months. In 3 months at 1.3 million is 3.9 million of revenue that we were able to potentially allow them to generate in addition to what they normally would have had to do. So that makes it a lot easier for that company to get through the stabilization of this asset. I want to clarify the definition of a value-add loan, meaning a portion of the loan proceeds are being held back in a fund control and used to improve the property. As we've already discussed, the faster the tenant improvements are completed, the faster the tenant can start generating revenue. Most private lenders take 5 to 10 days to process draw reimbursements from the fund control, and banks take weeks to a month. The cost of these delays can be millions of dollars in revenue. We are able to charge higher rates because the tenant can start generating revenues sooner. Our fund control draw reimbursement process have been streamlined and refined over thousands of loans. I'll quickly review the key fund terms. We're a Reg D 506C. Our targeted equity raise is $250 million for accredited investors with a minimum investment of $100,000. Our target net IRR is 15% with monthly distributions, and we do allow for reinvestments. The only leverage that we'll have is a warehouse line of credit. Our term is evergreen. Our lockup is 1 year, and then you can take 25 of your principal per quarter after the 1 year lockup. Our management fee is 1%. There is no hurdle. There is no carried interest split. The fund manager is Pelorus Management Group. We bank with First Federal Bank of Florida, which is an FDIC insured state bank that is cannabis friendly. Our legal counsel is Grassi Law Firm, and our auditor is Armanino. They do not only all of our audit work, our tax filings, our REIT compliance, and all of our back-end accounting. I'd like to introduce you to the principals. On the left is Rick Scatterday, our managing director. That's me in the center. And to the right is our CEO, Dan Limel. Together, we have more than 62 years of experience, and during our careers, we have weathered 2 real estate down cycles, 1 financial recession, and now the COVID-19 crisis. Why invest now? Pelorus is offering a secured, cash-flowing, alternative asset class that is non-correlated to real estate and economic cycles or the stock market. We have provided consistent double-digit returns for over 2 years. Sales of the cannabis are continuing to increase, and more states are considering approving medical and recreational use. Demand for our loan product is high, with more than $150 million in our pipeline. We also believe the equity warrants may be the most lucrative aspect of the fund over time. We've aggregated about 50 of the most asked questions on our FAQ tab of our website. to review, and some of them are here. So please go to our website at pelorusequitygroup.com or the Pelorus Fund, and you can read these FAQs. Our legal disclaimers are both on the website, in the pitch deck, in our securities offering agreements as well. Thanks for taking the time to view our presentation. For more information, you can go to our website at pelorusequitygroup.com or email investorrelations@pelorusequitygroup.